So I'm Charles Davis, I'm Director at Cebr, Centre for Economics and Business Research, and we've worked with YouGov on a joint economic indicator, a set of economic indicators under this wider monthly publication of the YouGov Cebr Consumer Confidence Index. But first of all, I thought we'd just give some thoughts on what we think is going on to the global and UK economy and why that's important, building on some of the concepts that Joe has given us there. So first of all, I think the global economy, I mean, it's a bit of a mixed picture. I think there is growth this year in Europe for the first time for 2 or 3 years. Finally, we've got a Eurozone economy that's growing, but it's still growing at a very anemic pace. And so we've seen the European Central Bank move to try and stimulate things further with their latest round of monetary policy intervention, and that was just last week. Across the globe, looking at the US, we've had a pretty weak set of results on the basis of some very adverse weather at the beginning of the year. But overall, I'd say that the shape of the US economy is pretty decent, and we're gradually seeing the Federal Reserve take their foot off the accelerator. But we're seeing emerging markets certainly grow less fast than we've been used to in recent years. So really, it's the advanced economies that are playing more of a role in driving growth this year than other years. And the consequence of that is that actually we're seeing commodity prices come back a little bit this year, and that's helping to reduce inflation pressure across the globe. So overall, as a backdrop for the UK, and the focus on the UK and the UK scenario, actually the global economic outlook is kind of more benign than it's been for probably 6 or even 7 years in the UK, because our key export markets are showing slightly faster growth, albeit not strong growth as yet, while inflationary pressures have come right off, whereas the last few years we've been very much used to accelerating oil prices and all the consequences that's had on real consumer spending. So it does finally look like a slightly less benign, less malign economic environment for UK consumers and for the broader UK economy, albeit that we could do with our key export market in Eurozone to really recover more strongly than it currently is, and there are still lingering concerns about the ongoing stability of the single currency area, whilst you have the major divergences between the core countries in Germany, Austria and so on, versus the peripheral countries like Spain, Italy and Greece, where they have exceptionally high unemployment. But overall for the UK, we're seeing the UK in a pretty much in a sort of robust place that it's not been for the last 6 or 7 years. We're going to see growth in 2014 build on the acceleration that we saw through 2013. We're probably going to see the economy as a whole grow at its fastest pace this year since 2007. And with data just announced from NISR yesterday, looking at a monthly estimate of GDP, we're finally actually seeing the level of economic output surpass the level that was the previous peak just before the recession really deepened in 2008. But of course, the population has grown in that time. So in per capita terms, in terms of income per household, things are obviously still a fair bit worse for many. And is the recovery being felt right across the economy is one of the key questions. However, there's no doubt that the confidence of businesses, and we can see we've seen a sustained increase in business sentiment, and that's now translating into higher business investment, which starts to self-sustain the recovery, and also sustained improvement in hiring, and that's helping to improve the labour market situation. So we've seen unemployment drop far faster than, say, the Bank of England expected. They've had slightly had an egg on their face around their forward guidance that they wouldn't think about raising interest rates until unemployment fell to 7%. Then, of course, unemployment has probably fallen 7% far faster than they expected. And indeed, when the latest labour market figures are out just this morning, we might well see another small decline in the unemployment rate further beneath 7%. But that acceleration in the economy and that wider improvement hasn't yet translated to an acceleration in pay. And so we've still seen households not experiencing sustained increase in real incomes and real spending power that they were used to before the crisis. Although certainly with those inflationary pressures that I mentioned coming from the global economy having eased, and with sterling having slightly appreciated over last year, we have seen inflation come right back down, and so the squeeze on disposable incomes has certainly come to an end. We're just not seeing robust increases in standards of living yet, but that might start to emerge a bit more as the year goes on in the coming years. However, it's two big risks to highlight over the coming years, and perhaps why there might still be a fair degree of nervousness amongst some households and scepticism about the recovery among some groups, is that we're going to see sustained public spending cuts in the next Parliament as the next government, whether it's under the coalition, whether it's a Tory-led or a Labour-led coalition, we're going to see further major fiscal consolidation to try and deal with its still significant deficit. Even though the economy is growing, that's helping to reduce the deficit. There's still a big structural deficit. That is a bit of a deficit that won't go away just with a resumption of reasonable economic growth. So there's still that big risk of what we call fiscal tightening. And then in addition, there's the risk of interest rates rising up from their historic lows. Bear in mind, since the Bank of England was founded toward the end of the 17th century, we haven't had interest rates at 0.5%, or only since really the bank was founded we had the historic lows that we've seen in the last five or so years. And so there is a point at which monetary policy will start to normalise, and we'll start to see interest rates gradually rising. When that exactly happens is not yet precisely clear, but it's certainly a risk in the next couple of years. So then just looking at the data that we produced together with YouGov and what that's showing, well, certainly it picks on that point that we're seeing a sustained improvement in confidence, and certainly we've now got consumer confidence at its highest level since 2007, since around, or just before the time of the Northern Rock bank run back in sort of September 2007. We're seeing confidence reach this post-crisis high. I think there are still concerns that there are differences across the UK, but on average, we're certainly seeing a sustained improvement, and we're now really probably above the long-run level of average confidence, which is not something we've been able to say for the last 5 or 6 years. But just looking at what drove that increase in confidence, interestingly, over the last year, it really was significantly driven by the housing market. So we saw measures from the Bank of England, sustained low interest rates, of course, quantitative easing, where they created new central bank reserves, and of course funding for lending, and then the government's own help to buy policy. And all of these measures, although funding for lending has now been rescinded from the housing market, all of these measures, I think, really helped to give a real momentum into the housing market, and it's been a classic story of a housing market-led recovery, where when you look at this data, just reporting on what average consumers are saying about their increases in their own home values, you can see that that was a major factor that transformed over the last year. We've started to see some of that momentum ease in recent months. The pace of acceleration has slowed a little bit, and certainly I think that's the case in London, but I think there's still a story of this wider housing market recovery spreading across the UK, and that is certainly helping. And on the back of that, we started to see construction activity pick up, and so again, the recovery started to become more self-sustaining. And of course, there is this more sustainable, really strong story of a labour market that has been creating jobs at quite a pace. On some of the numbers, we've seen the fastest growth in employment for many years. In London, I think it was the fastest growth in workforce jobs that we've seen since the mid-90s late last year. So you are talking about a serious rate of job creation, and that has, of course, led to unemployment declining significantly, as you mentioned earlier. But seeing how consumers perceive that, well, I think they certainly have started to perceive the turnaround in the labour market, and have actually really taken this into their own views of the world. So this indicator here just looks at the net balance of unemployment, of those expecting unemployment to increase or not over the next 12 months. And you can see, even just a year ago, many households still expect unemployment to increase, whereas now, on balance, there's a zero net balance of households expecting unemployment to increase in the next year. So there's this sense that the labour market improvement has really helped to give consumers more grounding in the sense that the economy is recovering as a whole. And at the same time, that story about reduced inflation is certainly being felt by households. So this measure is just looking at inflation expectations. You can see that there's been a steep drop in the rate at which households expect prices and the cost of living to go up eventually. And actually, it's the slowest pace of increase that they expect for about 4 or 5 years. So again, a sustained improvement there, which helps to reduce the squeeze in disposable incomes. When we look at a key indicator within the YouGov CBR economic analysis that we do. It's the cash availability indicator that's a really interesting one to me, because all these indices are scored such that 0 would be the very lowest that the indicator can be. 100 is broadly a neutral level. Anything above 100 is an increase, and 200 is really the maximum level. On this indicator, you can see throughout the whole period, that's 5 years, households have been net negative about what's happening to the level of spare cash. But what's interesting is that finally, over the last 6 months, and actually the broader trend over the last few years, is that the rate of decline has started to slow, and notably in the last 6 months, that's really taken a fairly significant turn upwards. We're still not at net positive territory where households feel they have more cash, but certainly we're at a point where household finances are stabilising and probably return to growth in spending power, which can ultimately sustain consumer recovery. Is getting closer. But of course, the key challenge ahead, I think, as we mentioned earlier, is what happens when interest rates rise. Interestingly, when the forward guidance was announced, the YouGov data we have here shows that in August 2013, we had the lowest balance of consumers expecting interest rates to increase over the next 12 months or so. But actually, since the forward guidance was announced last summer, we've seen a sustained increase in the amount of households that expect interest rates to rise. And so now we're up to around 2/3 of households expecting interest rate rise in the near future. Whether they're fully prepared and whether all households are as well prepared for interest rate rise, I think remains one of the key questions to look out for over the coming year. So I'm Charles Davis at Cebr, and do look out for the monthly YouGov Cebr Consumer Confidence Indicator. I hope that's been a useful overview. I think we'll now have time for some questions. Thank you very much.